Is anyone else confused between the differences in an exchange-traded fund, a mutual fund, and an index fund? Good, then you're watching the right video, because I'm going to cover the differences between each of these funds by defining them in detail, explaining how you can invest in each of these, and also their fee structures. I'll then finish off the video by going over the pros and cons of each of these funds, and then also discuss the situations where you'll most likely make these investments. Let's get started with the mutual funds, since they are both the backbone of both the index funds and the ETFs. For curiosity's sake, what year do you think the first mutual fund was established? Was it in 1984, 1954, 1924, or even 1914? Well, if you guessed 1984, then you're absolutely wrong, because it was 1924 and the first mutual fund was the Massachusetts Investors Trust, which is still in existence today. Can you imagine if you had a relative that passed down a mutual fund that was 100 years old? Well, I can imagine what it would be worth. I would literally say, holy Schitt's Creek is a funny show, but they don't sponsor my videos. You do. Each and every time you hit that like button. Feel free to leave comments below on what you think about my content, and it would be great if you'd subscribe as well. So getting back on topic, what exactly is a mutual fund? In simple terms, it is a pooled set of assets that invest in stocks, bonds, and other forms of securities. The intent of the mutual fund is to use this pool of assets to purchase a broad set of securities so that it creates diversification which minimizes your risk while maximizing your growth. If a mutual fund contains hundreds of stocks or bonds, if one or two of these stocks take a major nosedive, then the overall growth of the rest of the portfolio allows the fund to still be profitable. This is where a mutual fund helps to minimize your risk. Overall, it is much safer than buying individual stock. Now, a key item to note about mutual funds is that they are actively managed. There is a dedicated fund manager that manages the assets and buys and sells the stock or securities within the portfolio as they see fit, and they're trying to time the market. Because mutual funds are actively managed, they come with higher costs to pay for that level of management, and this is seen as expense fees tied to the mutual fund. These fees often range from 0.5% up to 2%, and in addition to the expense fee, some mutual funds also come with a sales fee. This may be a 5% fee tacked on during the purchase of the fund called the front-end load, or it may occur when the fund is sold, which is then called the back-end load. The moral of the story? Do your homework on mutual funds when it comes to fees. The next portion to cover is minimum investment. How much do mutual funds cost to invest in? Unfortunately, the answer isn't simple because it varies. Some mutual funds may only cost $500 for an initial investment, but there are also mutual funds like one from Vanguard that has an initial investment of $10,000. Now let's say you want to buy the Vanguard Wellington Fund. Then you can only purchase it from the Vanguard Group. Mutual funds are offered solely by the individual management groups where you have to invest with them directly. You can't simply look up a mutual fund on Robinhood to make the investment because they won't be available. And because of how mutual funds are managed, you can only buy or sell your investment in a mutual fund after the markets have closed. And when it comes to minimum investments in a mutual funds, there does happen to be a little bit of a caveat to that rule, because most 401k plans do offer mutual funds that don't have a minimum investment guardrail, but they do still have all the fees tied to them. Granted, your 401k is one avenue for purchasing a mutual fund, but chances are your employer plan only offers you a dozen different mutual funds, which may not offer you what you want. Next, we'll move on to index funds, which was first launched in 1976 with the Vanguard 500 Index Fund. In essence, an index fund is a mutual fund, but with a very specific strategy. And that strategy is to have a large enough assortment of stocks which are meant to mimic or index against a specific market, like the S&P 500, the NASDAQ 100, the Russell 1000, or even the Dow Jones Industrial Average. Since index funds marry up to the market, they require very little effort and are considered passively managed. Inherently, passive managed index funds have lower expenses, and the average expense ratio for an index fund is only 0.18%. Because an index fund is a strategy more so than it is a unique asset, it is available as both a mutual fund and as an ETF. For this reason, the expenses, the ways to purchase, and the means of cashing in an index fund all fall within the special requirements of either the mutual fund or the ETF, depending on which one you had invested in. I feel that it's important to now review the exchange-traded funds to help bring this all together. Similar to mutual funds, ETFs pool their resources together to purchase a large variety of stocks, bonds, and other securities. And just like a mutual fund, an ETF has a great deal of diversification because of having dozens or even hundreds of assets in their portfolio. However, ETFs are mostly managed passively by matching the performance of an index or a niche, which results in lower expenses. One of the key differences between a mutual fund and an ETF is how an ETF is traded just like any other stock. And because it is traded like a stock, you can purchase any ETF that is available with any investment app. If Vanguard offers an ETF, then it is available across every investment app because the ETF is listed on an exchange. Now, when it comes to a minimum investment, ETF is a clear winner. If the ETF price is $100, then you can purchase one share of that ETF for $100. But if you use a trading app like Robinhood, then you can purchase any dollar amount you like because they offer fractional shares. So even if an ETF goes for $100 a share, you can buy $5 worth on an app like Robinhood, which is also commission free. However, if you use a trading site that charges you a commission per trade, then you will incur that expense every time you purchase or sell an ETF. Throughout the business day, you can see the prices fluctuate on an ETF, and you can choose to buy or sell those shares of an ETF at any time that the exchange is open. Looking at these three types of funds in the big picture, the index fund is a strategy, and that strategy can be implemented in both the mutual funds and the ETFs. Think of it like this. The mutual funds are like a private golf course where you pay a fee to join. Then there's the public golf course that is open to everyone without any upfront fee, and that would be your exchange traded fund. Both the private golf course and the public golf course sell the same bottles of Coke. It's the same product, but with slightly different prices. And in this example, the Coke is the index fund. Both places offer the same type of item, but when you boil it down, a Coke is a Coke. At the beginning of this video, I gave a little history lesson about mutual funds where they are approaching 100 years of existence. For that reason, it's obvious that mutual funds are far more popular than ETFs, but that is slowly changing. In looking at this chart, you can see the index funds and the ETFs have been growing at a very rapid pace, while actively managed mutual funds are on the decline. Granted, mutual funds make up 27 trillion in assets, while ETFs are only at 10 trillion. But given their differences, I believe that ETFs will quickly catch up to mutual funds in the next 10 years. And I believe going over the pros and cons will help illustrate why. And with that said, let's get on to the pros and cons in the mutual funds. The first pro is diversity. They provide broad diversification to help minimize your risk and maximize your return. They are also the most popular of the funds and readily available in your 401k. And lastly, they have a strong historical performance. Now moving on to the cons, they have high expenses due to being actively managed. They also have high sales fees with possible front-end or back-end loads. They also have high minimum investments, and trades can only be made after the market closes. They also have compressed availability, meaning they are only available by a very specific asset management group. And last, they are less tax efficient. Because a mutual fund is not traded like a stock, then when an investor wants their money, the fund manager has to sell that asset for the payout, which results in more capital gains that need to be passed on to the total return of the fund, which brings the performance down. Next, I'll move on to index funds, which is more of a strategy than it is a unique asset. The first pro is that they match the performance of the market, so you kind of know what you're getting into. Next, they have very low expenses, and they are widely available between mutual funds or ETFs. Moving on to the cons, and I can only really see one, and that is that they have less opportunity to outperform the market, but that's why it's called an index. Next, I'll cover the ETF pros. They trade like stock, which makes them more liquid than mutual funds. If you need quick access to your money, it's available. They also have a very low minimum investment, and they have low expenses. And last, they are more tax efficient. Because it is traded like a stock, assets don't need to be prematurely sold to pay off their investors. The ETF is bought and sold among investors, which dodges selling the assets outright and incurring capital gains. And the cons for an ETF? They have odd offerings. There are some very strange niche ETF available, like Gen Z ETF or the Millennial ETF, that may be more based on emotional attachment versus objective performance. These lower traded niche ETFs carry less liquidity if they are trading at low volumes. So make certain the ETF you invest in has a decent amount of trade volume to ensure that you have good access to your money if you need to sell it. And the last con for an ETF is less historical performance. They're the newer kid on the block, so they don't have as much historical performance to rely on. Overall, each fund has its own set of benefits. And in some cases, such as your 401k, you may only have one purchase option. Just know that if you invest outside of your 401k, and I hope that you do, then index funds and ETFs should absolutely be a part of your portfolio. That concludes my comparisons of the mutual funds, index funds, and ETFs. I sincerely hope that this video has been helpful for you, and as always, be smart with your money, and thanks so much for watching.